Good evening, everyone. I hope you're all keeping good and excited for the second part of the working capital management. I can see a lot of activity already on the query panel, a lot of students waiting for the sessions to start. Good evening, Alok, Dinesh, Nipun, Sapna, Jyoti, everyone, Geet, Pranav, and Jaspreet. So all of you, a warm welcome to the continuing session of our working capital management. I hope each and everyone is spending adequate time enough in practicing some good questions. So the last time around, we met on a Sunday evening, right? We talked about working capital management, importance of the working capital. We discussed operating cycle, and we talk about that. Okay, the number of operating cycles, more in a year, better it is. So you would always prefer a shorter operating cycle. Then we moved on to calculate working capital requirements. I think Sunday, a little bit of a tricky element which was disturbing us regularly was the WIP part, right? That was a little tricky in a couple of questions. Then we also moved on to the significance of WIP when it comes to single shift to double shift. So it was a good mind absorbing session on Sunday evening that ended on this exactly the slide, that is the treasury management, right? I hope everyone recollects that most of the organizations have in the current day scenario, in fact, almost I would say last decade or so, have a different department named as treasury department. They have multiple objectives or functions, you may say, which involves liaising with the bankers, managing and timing the collections and the payments of the cash, and then also associating the coverage of any risk related to the company in terms of hedging, and also I told you that yes, in the recent years, the corporate finance function or acquisition or valuation of the organizations is also very, very important function of the treasury department. Now, today we intend to start our discussion with something very important with respect to the cash management. And as I say so, we will be, touching base upon an individual elements of the working capital management. We'll talk about cash, we'll talk about receivables, we'll talk about inventory, we'll talk about creditors. First, we'd like to start with the cash management. Now, everyone understand the significance of the cash. Yes, and when I say cash, in the present day scenario, it's not only the cash in hand, right? I hope everyone understand that. Cash refers here to liquidity, whether you are carrying in your account or you are talking about in the terms of currency. But yes, we need to understand that need for cash can be broadly categorized into these three categories, in the sense that you may need funds for your day-to-day operations, that is your transaction need. You may need some liquidity to arbitrage any kind of a temporary advantage. Let's say you talk about your individuals, right? Imagine that there is a significant fall in the stock market over a few weeks. To take an advantage of that decline, if you want to invest in some good stocks, you may need liquidity, right? So speculative motive is another motive. Now, precautionary, I think that is very much the case. I think right sitting here on my seat, I can very well see in your wallets, right? I'm sure many of you can acknowledge here. How many of you carry that behind the photo in your wallet? I'm not talking about the photo of your friends, but religious photo or whatever you keep, your parents, you keep a 2,000 or a 500 rupee note, right? Am I correct, guys? Many of you keep that. You keep it as an emergency money. Let's say you are out somewhere and you're short of cash. You want to keep some kind of a caution here, right? I'm pretty sure. So even from an organization perspective, you would need some cash for meeting any kind of an unexpected event, as a buffer. Although I understand, gone are the days where if you had stepped out of your house and you left your wallet back home, you would have definitely gone back to collect it. But these days, with a lot of digital money, no one is that much worried about the wallet. But I think everyone is so worried about not leaving their mobile phones at home, right? Especially in the custody of parents. Am I correct? So Anyway, so basically coming back to cash management. So transaction need, speculative need, and precautionary need. Now, to ensure that organization doesn't fall under liquidity crunch. Remember, on Sunday, we also talked about when we started the importance of working capital management. We discussed about the balance between profitability and liquidity. So here we are talking about how do we ensure that, okay, there is no unnecessary excessive shortage or other excessive, I would say, blocking of the funds or surplus funds. Either side is not so good. You don't want a shortage of cash at some point, or you do not want excess being piling up because you are losing some opportunity cost over there, right? So it's very, very important, the aspect which relates to planning and budgeting the cash element. What you need to do is basically this is again the role of treasury team comes in, where they coordinate with, let's say, order to cash team. They coordinate with them with the collections that are coming their way, and they also coordinate with the AP team, accounts payable team, and also payroll team. When are the disbursements required? So you need to coordinate the timing of cash. This is important. If you know that, okay, there are funds coming in 21st and you need a payment on 23rd, so you know that you are safeguarded. Now, different methods are there for budgeting the cash requirements. We call it as different names. One is a receipts and payments method, which is like we know the periodic information flow through basically in terms of different months or quarters, what are the inflows, what are outflows. Or we also have another method which is reflected from the cash flow statement itself. That's an adjusted income method, wherein we accrue or we adjust the net income for any kind of a change in the current assets and current liabilities. And also another method which is adjusted balance sheet method, where we generally focus on each asset and short-term liability to be expressed as percentage of sales, to ensure that, okay, whether we have a shortage or a surplus, if we were to compare that with the long-term liability. Remember, assets minus liabilities is equal to equity. So when you say balance sheet approach, we are looking at, okay, each asset and a short-term liabilities expressed as a percentage of sales. You would know that, okay, hey, are you kind of in a situation where you have liabilities exceeding your assets? However, theoretically purposes, it becomes evident that, okay, you need to know what are the different methods of cash budgeting. But we would be more or less focusing on the first one, that is our receipts and payments, wherein the information will be given to us. What are the receipts over the different periods? What are the payments over the different periods? What is the buffer they need? Remember, in the working capital also we discussed 10% extra, 15% extra. So all that is also part of the cash budget. So let's understand a little bit more about the cash budget here. Now, as I said, it's a very, very important device to plan, to monitor the cash receipts and payments. And the idea is that in case you have a surplus, you may want to kind of invest in marketable securities or short-term deposits. Remember the example I gave you on Sunday that in Whirlpool the treasury team was negotiating with the bankers for interest rates on 4 days FDR, right? So, and in case you feel that, okay, there is a shortage, you may also want to liaise with the bank to ensure that you have a necessary overdraft facility, right? So various purposes of the cash budgets are aligned with the treasury management objectives. Let's say coordinating the timings of the cash needs, when you have a surplus or when you have a shortage, that is definitely flowing away from the first point itself. If you are likely to have excess cash, probably you will be able to liaise with the bankers or any other investment opportunities. Also, it is very, very important sometimes, when you interact with the vendors. We will talk about that when we talk about the sundry creditors management, wherein they may offer you a scheme like, if you pay us early, we will be offering you some discount, which is called as a cash discount. Now we will be discussing, okay, whether taking a cash discount is advantageous or probably paying on the last day's advantages. Reason being is we will have to compare, right? If we have to take a cash discount, we have to arrange for funds early. And if you're arranging for the funds early, we are probably having an opportunity cost. So that is the discussion I will be having again when we reach the accounts payable management. But right now, I want you guys to just understand the broad umbrella view of this. Then yes, if you have a sufficient extra or surplus cash, you may decide between, okay, whether you want to avail any kind of a cash discounts or you rather want to invest somewhere else. See, it's simple that, okay, if the cost of that discount, if the discount what you guys are availing is, let's say, much more attractive than the interest rate you would be getting by investing that surplus somewhere, you may definitely want to go ahead with the discount. Or if it is vice versa, you may want to think that, hey, if the interest on the deposits is much higher than the discount I'm offered by the vendors, so why do I need to pay early? So this is the point we will be again taking up when we will be discussing about the creditors management. We will be significantly talking about the cost of not taking a discount. We will be talking about the credit terms at that point. Let's say a credit terms supplied by a vendor is 1/10 and 30, which is just signifying the fact that the credit period is 30 days, but if you pay within the 10 days, you'll get a 1% discount. So that is a comparison we will do later. Also, cash budget could help you to circulate the funds in such a way that when it comes to negotiations, when it comes to licensing, you are not on a shortage side of funds, and hence you end up falling on the favorable terms for negotiation purposes, because it's always comes to the point who needs funds more. If you have the surplus and you know that you are a regular customer of a financial institution, you may be in a position to bargain, let's say, a higher 0.25 basis points in terms of the interest on deposits. I'm just quoting as an example, guys. If you are able to manage the balance of your funds in such a way that you avoid shortage, then you will definitely help your treasury team basically to arrange or license with any kind of an arrangements which are more in your favorable side. Okay, so these are different purposes of the cash budgets. Now, as I said, we need to understand that in terms of the budgeting, the most important aspect is when are my collections coming up and when my payments are getting due. That will help us to identify two most important areas, like the area where my surplus is there, and maybe some period of time I might face any kind of a liquidity crunch. So I should be able to liquidate those short-term marketable deposits or liquidate those securities, which could help us to meet that shortage. Or other way around, if you do not have any kind of such arrangements, you should have licensed with the bankers for any kind of a overdraft facility. So let's understand this. So in terms of budgeting, the first step which is important is that what is my period covered? Are we doing for a short term or we are doing for a long term? Our discussion will start with a short term budgets, let's say 6 months, 3 months, and we will also discuss long term budget at the end, which will be like more like a forecasted income statement, focusing on for the cash. Now, the second aspect is we need to specifically highlight and identify the factors which are affecting my inflows and outflows, and majorly onto the operating and financing side of it. Okay, let me ask this question. Why I am saying here categorically operating and financial cash flows? Why are we not even talking about the investing cash flows? Is investing cash flows not relevant here? Of course it is relevant, but why we are not focusing on that as well? So let's see your responses. First question from me. Why we are only mentioning the operating and financial cash flow? Any thoughts? Okay, so the first answer coming in from, let me refresh the query panel. Okay, Jyoti comes with a very, very good answer. I'm waiting for other answers before I speak out. Okay, Jyoti, Pranav, Chash. Just, I think maybe you are close to that answer, what I'm looking for. Just that you are wording it a little differently. Let's see, what about others? Okay, yeah, I think Alok, Dhyanesh, good. So I think most of you are trying to give a very, very good answer here, which suggests that, okay, see, regular inflow and outflow would be affected by these two activities. But investing would not be a very regular feature of your planning. You may acquire a PP&E or a non-current asset, you may dispose of, but that's not happening very, very regularly, right? Am I correct? Whereas operating and financing cash flows definitely are the part, because the financing cash flows is also important because it may relate to that, part of your source of capital is from a debt, right? So I think even Geet says that, because investment decisions are not often and not similar with respect to the other aspects. So I think pretty much good answers, guys. Very good. All of you are on the same page. That's the best part. So if you see this graph, we are looking at a denominator, or rather, I would say x-axis, which is reflecting a time frame which is various months of a year. Now, what is this reflecting us? This is just reflecting us the periods of peaks and the lows. Right? Let's say you are having a good season from somewhere in the month of March to June, July, or then you are having a situation where you are having some kind of a deficit right from August to November. How you want to focus on those excess or the surplus situations or deficit. I think that's the key part here, because something which is more with respect to the normal balance, which is right in the middle, that is still okay. You would like to balance that or ensure that generally you're carrying those levels over there in terms of cash and bank. However, having said that, on a rainy day, if you are shortfall of something, you should have aligned yourself, licensed yourself with the bankers and the treasury managers as a team, so that you have that overdraft facility. I hope that makes sense for everyone here. Okay. Now, let's talk about the cash budgeting aspect, which I said that we'll be looking at the short-term budgeting first. So when we look at this, cash budget for a shorter period, we would generally go by month. It's important that we analyze. Coordination is a very, very important key here, because every month you would have some receipts and some payments. And the best part is all of these are majorly driven by some estimates. Now, my point is, and this is the second question from me to all of you, how would a team be able to make an estimate on this? How would a treasury team, a person who is preparing the cash budget, will be able to estimate the receipts and the payments, guys? Let's see your responses. Okay, Jyoti says past performance. I was pretty much sure that you guys would be right on the past trend. And that's what Geet also said. Any other aspect, guys? I'm looking for one more aspect which I have been repeatedly saying in the last 10 minutes. Pranav includes both the aspects. Pranav says past experience or things prevailing in the market. I think I would like rephrase the second part though. But let's see other answers. I think overall everyone is like highlighting on the past trend. But guys, what about apart from the past trends, is it that you guys are assuming that somewhere down the line, those past trends will be coordinated with the different teams. Am I correct? That coordination part is important, because what happens is past trends is a good number to start with, but what is going to be new this time around, that will only come to you when you coordinate with this different departments, right? As a starting point, I'm okay. You can take from past time. But let's say if you're talking about a first time scenario in a particular division for a company, so the coordination between different departments becomes very important. You talk about to the marketing team to get an idea about the market share expected by the company, the top line expected by the organization, that is your sales. And similarly, I would say that you would associate the discussion with the AP team, the procurement team, to ensure to understand the payment requirements to different vendors, and also with the payrolls. So what are the categories within the broad two sections? With the receipts, we are looking at the receipts from debtors, cash sales, of course, and any other receipts in terms of the investments and so on. Payments, again, the purchases, whether it is cash and payment to vendors on credit. Expenses. Now this is the third part is very interesting. Payments that are made periodically but not every month. Could be the debenture interest, could be the tax. Generally the advance taxes paid is quarterly, could be GST. And also in terms of some special payments could be made to the investors, like dividends to the shareholders, or debentures or the bonds could be redeemed, loans to be repaid. And that's why I said, right, operating and financing activities are important here. And why we are using the special word is because we are not doing that on a daily basis, right? Although it's like more of a financing activities, but it's important source of a cash flow here. Yep. Let's understand, the entire aspect with the help of a practical exercise. And this is a very, very, I would say, comprehensive exercise in terms of the cash budget preparation. And I'm sure you guys will really enjoy it. So I want everyone to be on the top of their concentration levels now. And you want to participate with me, you guys have to give me some numbers here. Right? So prepare a monthly cash budget for 6 months, beginning from the 2019 April on the basis of below details. And look at this, they've given you the sales for how many months have been given, guys? Jan, Feb, March, April, May, June, July, August, September, October. Okay. First question is, guys, 6 months, right? 6 months is what we are looking for. Means April, May, June, July, August, September, right? So why the hell are we getting the estimated sale from Jan to March and even October, guys? Any thoughts? April means April to September, right? Why do we need the other month sales numbers? Any thoughts? Anyone, guys? For GST payables, okay. Okay, I like the reply for Alok. Alok says last month's debtor received. Guys, we're talking about cash budget, right? Forget about accrual now. So there could be a scenario where January sales, some collections could be coming in April, right? So that is something we'll be now discussing in the additional information given to us. Now look at the second section. They're giving you estimated wages for April to September. Very good. And look at the first point. Of the sales, 80% is on credit, 20% in cash. Now, the next section answers that question. Sapna, Sharan, Manoj, absolutely correct. Even Abhinaya as well. Right? So 75% of the credit sales are collected within 1 month. 75% of the credit sales, 80% into 75, 65, total 60, right? 75% into 80% is 60% of the total sales. And the balance in the second month after sale. So we may have some part of the Feb month coming in March and some part of the Feb month coming in April. There are no bad debt losses Purchases amount to 80% of the sales and are made on credit and paid for in the month preceding the sales. Wow. So 1 month prior. Okay. So the firm has 10% debentures. Interest on these has to be paid in quarterly, January, April, next is July. So you need to be very careful. Interest part would be affecting April to September period. So we will be taking 2 interest payments, if I'm not wrong, April to July, April and July rather. And they're also talking about payment of advance tax. So don't miss out that. Advance tax is in the month of July. Now the firm had a cash balance of 20,000 on 1st April 19, which is minimum desired level of cash balance. Any cash surplus or deficit above, below, or this. Now this is important, is made up by temporary investment or liquidation of temporary investment or temporary borrowings at the end of each month. So either you are making temporary investments, or if it is a shortfall, either you liquidate that, and if you don't have the investments, you can take a borrowing or an overdraft. Guys, everyone is clear? On the call of the question? A lot of information given to us. Any thoughts, any questions, any queries on so far so good? Okay, so let's do one thing. First of all, let's try to understand the collections from the debtors, guys. You know, there are cash sales also. Every month, 20% is the cash sale. That's straightforward. I'm not worried about the 20% cash sale. So like April ka 16,000, May you have 12,000, June you have 16,000, and so on. So let's understand the collections part, debtors collections. But for that, we need to know that debtors are 80%. So let's see this. The total sales for all the months I mentioned from Feb, because see, my credit period is saying that in the next month and next to next month. So April collections would involve March and Feb, right? So the first step is we multiply this into 80% to calculate the credit sales. All the months sales are multiplied by 80% to calculate credit sales. Now this is my credit sales. Now 75% of this is collected in the next month and 25% in next to next month. Similarly, when we talk about 75% of March is going in April and rest is going in May. I want to go a little slow here. So if I see March number, March credit sales is 1,12,000. Out of that, 75% is 84,000. So 84,000 is the month of April, and the balance 28 is in the month of May. Yes, everyone getting it? So April month involves the credit sale collections of Feb and March, but not April, because your credit sales are not being collected in the same month. Similarly, May month would have collections from March and April. June will be from April and May. So what about, let's say July? July's credit sale is 60,000. Out of 80,000, sorry. Out of 80,000, 60,000 is collected in August and 20,000 is collected in September. So guys, everyone okay here on this particular screen? Let me know if any questions. Of course, the starting point is that we need to ensure that, okay, all the sales, my starting point has to be very clear that all the sales are comprising of two parts. 20% is cash sales and 80% is credit sales. Great. And accordingly, we make the total collections here. So once we have the total collections, I think we are on the very much on the right track to calculate or create the cash budget wherein we can show the receipts part first, then the payments part, and then we can compare, okay, receipts minus payment is how much, right? Whether it is more than 20, less than 20. If it is more than 20, we could go for a temporary investment. And if it's like less than 20, we could go for liquidation or borrowing. Okay, there is a question. Jasprit says, why we started from Jan? So, okay. So, or Feb rather, right? Jasprit, that's what the question was. Why did we start from Feb? Jasprit, because can you read the credit policy here in the question? The 75% of the credit sales are collected within 1 month, and the balance in the month after the sale. So if you look forward, let's say, take an example on the right hand side. What will be the collections in the month of, let's say the first question is in the month of April. As per the credit policy, some part of Feb collections and some part of March collections. Similarly, if you think, what is the collections in the month of May? Mind you, May's credit sales would be collected in the month of June and July, right? So in this case, some parts of March collections would be coming in May and some parts of April. Jaspreet, this makes sense now? That's why we had to start from Feb. We had to take the impact of the Feb's collection in the month of April. In the current month, I am receiving the cash collections from previous 2 months, and the current month's credit sales are being collected in the next 2 months. Okay. Thanks for clarifying though. Anyone else wants to ask any question, please let me know, guys. Okay, now we are on the track for preparing a cash budget, but for that, I want everyone to read the last paragraph again here. I want everyone to read the last paragraph again. The firm had a cash balance of 20,000 on 1st April, which is the minimum desired level of cash balance. Do you all agree with me that this line suggests that every month beginning and the ending balance would be 20,000? Do you agree with me? Because excess is also invested and the deficiency is covered by overdraft or sale of investments. Make sense? So if that is the case, if you look at the cash budget now, I want everyone to look at only April month right now. Only April month, guys. So opening balance is 20. Now cash sales is only of April, right? How much was April sales? April sales were 80,000. 80,000 ka 20%, you get 16,000. Collections from the month of Feb and March, what is that? 1,08,000. Jyoti says, why Jan balance is given? Jyoti, they might give you 2 or 3 additional information. Don't worry about that. They might have given, so we may or may not use the information depending on the requirements. Make sense? Okay, so we are only focusing on April month, guys. Don't look at May, June, July as of now. Only April. Cash sales, April month sales into 20%. Collections from our previous working, 1,08,000. So total cash available is beginning balance plus the cash sales and collections is 1,44,000. Now what is payments, guys? Now look at the language of the question. We are talking about the purchases are amounting to 80% of the sales and are made on credit and paid in the months preceding the sales. If we talk about the month of April, do you agree 80% of the May sales will be the April payments? for the purchases as per the language. I want a quick confirmation from everyone, guys. Quick confirmation from all. Everyone got the purchases line in the first bullet point. Purchases amount to 80% of sales and are made on credit and paid in the month preceding the sales. So that means for the April, the payments are 48,000. Can anyone tell me for the month of May, what will be the payments? Just asking casually if you interpreted it correctly or not. For the month of May, what would be the payments to the vendors for purchases? Jasprit, you need to just understand the collections and the payments period. Other than that, there is nothing confusing. So answer my question, what will be the payments for the vendors in the month of May? Okay, I think everyone understood it perfectly. Geet, Piyush, Abdul, Pranav, everyone is like pretty much solid right now. They're saying that, okay, the month of May would be 80% of the June sales. So that would be a 64,000. Perfect answer, guys. Perfect. So let's move on. So that is my purchases payment, 48. Wages was given to us straight away. Interest on debentures. Now, mind you, only April and July, I remember. 10% debentures. So 10% is like 1,20,000 into 10%. If there is a quarterly interest, that will be 1/4. So 3,000 will be the debenture interest. Right, Priyanka? So basically, wages is given to us. Interest on debenture is 3,000 for April and July. So that you can see they are mentioned in the month of April and also in the month of July. Now, taxes they have mentioned in the month of July was 5,000. So that's only in the month of July. We are anyways focusing on the April. There were no taxes. Now look at my total payments, guys. 48 plus 9 plus 3. My total payment is 60. So if I talk about 144 minus 60, $84, and we need a balance of 20. That means we are looking at a 64 as a surplus here. Do you agree with me? 144 minus 60 is 84, and 84 minus 20, that is 64,000, is what you could invest in the surplus funds. All okay, guys? You could invest that. So after investing 64, you will be talking about a 20,000 balance, closing balance. And as we discussed earlier anyways, what we're looking at the beginning balances for all the months. So is the ending balance. So all months is 20 beginning, 20 ending. Okay, can we look at one more month here? Month of May, or yeah, I think May month looks good. So what were the sales in the month of May, guys? May month sales is 60,000. So 20% is the cash sales. So that's a 12,000 here. Yep. Corrections from debtors taken from the previous working, 76. So total cash available is 1,08,000. Jasprit says it means keeping 20 as a minimum. Yes, Jasprit, absolutely correct. You could invest the surplus. That's what we are calculating. Now, in the month of May, I'm looking at a payment of 64,000. That's what you calculated earlier. I had asked you this question. Wages are given to us. So total payments are 72, whereas the total cash available is 108. So that means 108 minus 72 is 36, and we need a 20,000 balance. That means we again have a surplus of 16. We again have a surplus of 16, guys. You can see on the right hand side. Okay. Sharon says, sir, can the purchase of April will be March? Sharon, yes, but we are not preparing the cash budget for March, so we can right now ignore that. But to carry forward your question further, that's why we needed the month sales for the month of October, because September's purchases will be that. Yes, Jaspreet. Interest is quarterly payments, so not every month. Tax is also in the month of July only given to us. So is May month clear to everyone? 16,000 surplus. Just giving 1 minute to all of you. Okay. I think let's also look at quickly June month, and then the other months is pretty straightforward. I just want to see showcase a scenario. What if there is a deficit? Now in the June month, what were my sales? 80,000, 20% is the cash sales. So that's a 16,000, and the collections were 52. We're just quickly looking at June month here. 16 and 52, including the beginning balance, my total cash available is 88. Now, from the payments perspective, what is my July sale is 1 lakh. So that means 80,000, 80%, 80,000 will be the purchase or the vendor payments. 80,000 this, and the wages and salary given to us, 90. So mind you, we are having a total cash available of 88, whereas the payment is 90. That means it's a negative 2,000. But please remember that you need to keep a balance of 20. So that's not a negative of 2, it's a negative of 22. It's a negative of 22 here. And we need to understand, since there were investments of 64 here, 16 here, so total 80,000 investment you have, that could be liquidated here. So you can cover up this deficit by liquidating the investments. You don't need to go for a I would say overdraft as of now. Guys, all okay? Similarly, July, August, and September can be interpreted. I think you guys can look at the remaining 3 months at your disposal later on. I've covered 3 months. Any questions, guys? Let me know, please. The most important part is to remember, some students tell me that, okay, sir, can we just leave that 20 aside and just work on the collections and the payments? That's okay. Even that is okay. Because that you have to mention, then your presentation is around that. Okay. Just consider the dose for. I think what you're trying to say is that, again, then just there is a vicious circle, right? There is a vicious circle. You may not, if say that in a particular month there is a shortfall which is not even met by January, what about December, which is not given? So we can't really go back and back. So let's use the information which is relevant. Pranav has an interesting question. In this, are we assuming that investments can be redeemed in part also or any fraction? Yes, of course. When we talk about investments, I know like there are various instruments available these days. I know what you're trying to say is probably if there is a fixed deposit being made. Now that is sometimes, or most of the times, a part breaking of a fixed deposit may not be possible as such, but you all understand there are schemes like, sweep account, right? Wherein whatever funds you need kind of are taken from that particular FD also. Dinesh says, where can we invest 64,000 and then that we will get on demand? Again, Dinesh, could be a fixed deposit or it could be marketable security short term. Of course, judging the risk associated of liquidity. Jaspreet has a question here. Sir, if we haven't sufficient investments, then bank overdraft. Yes. Yes, Jaspreet. So of course, see, the idea is that either you are liquidating the investments or borrowings. Like, look at this. So they mentioned two choices here, na? Liquidation of temporary investments or temporary borrowings. They're giving you two things here. So if you don't have enough investments, and that's what Josh also asked, so we'll go for temporary borrowing then. Great, guys. I think this question, this example, this illustration really helped everyone to understand and evaluate the all aspects of the cash budget. Are we quickly ready for maybe one quick exercise more in the class? Okay, let's do that. I want everyone to quickly go through the information on your slides. Just read the question, please. Just one more quick exercise. Pranav had a question. If a share is 100, but we need only 50. Okay. Pranav, again, we are talking about a little bit of a situation where you are talking about just one share of a heavy amount, right? I think then your treasury department need to be smart enough and don't invest in a denomination of a single unit as a huge amount, or rather go for a deposit then. Geet says, if we want to invest saving, if you wanted to invest savings, what is the option for a student? Okay, Geet, again, yes, as you rightly said, it's not the part of the module though, but if you want me to guide you on a I would say investment avenues, whether you go for a it's a risk appetite, Geet. If you want to invest in the stock market or mutual funds those are like a little bit of a risky elements. But if you want to go for a typical PPF it depends on, if you don't want to take a risk, go for a fixed deposit or a PPF. But generally, if you are young, when you start earning, they generally advise you, let's say 100 minus your age is the amount of risk you can take. So let's say if someone is 20 years, 80% risk can be taken. If not 80, at least, let's say if you're saving 10,000 per month, you could actually invest 6,000 in mutual funds. That would be advised, because it may not be advisable to straight away expose yourself onto the equities. And even if you get some kind of a learning experiences, you can definitely think of big companies like, blue chips, we call it as, like, big companies like Reliance, you talk about Tata Motors, or, so big companies, which are like blue chips or the category A stocks. But otherwise, I think to start with mutual funds, the SIPs, we call it as a systematic investment plan. But anyways, let's come back to this. Yes, I think Manoj has a very valid point that do not put all the eggs in one basket. So even if you're saving 10,000, put 5,000 in mutual funds, or put some amount in a PPF, something like that. It is a good advice. Thanks, Manoj. Okay. So coming back to this illustration, guys, I hope everyone is reading the information here. We are required to calculate or prepare a month-wise cash budget on a receipt and payment basis for 3 months. Okay. Ending 31st March 19, it is anticipated that the working capital at 1st January, okay, I'm giving the beginning numbers: cash in bank, investment debtors, stock creditors, other creditors, dividends, taxes, and plant. And they've also given you the budgeted P&L, sales, cost of sales, gross profit, and net profit. Depreciation of 60,000 is included, guys. So make sure that we need to check for that, because we're talking about the cash budget here. And depreciation is a non-cash. And mind you, they're giving you other balances also for 3 months, right? Short-term investments. Now, very interesting, right? So short-term investments like going from 700 to nil and then to 200. So that means probably you are liquidating the investments in between and then investing again. Similarly, you have dividends payable paid in the month of February. It seems that, right? So a very important and interesting question here. You need to prepare the 3 months budget, but can anyone tell me what could be our starting point? What could be a starting point before we even go for the budget? I think we have a lot of information with respect to creditors, debtors, right? Any suggestions? Maybe would you like to prepare a statement which helps you to calculate the payments to the creditors and receipts from the debtors? Am I correct? That would be the starting point. What do you think, guys? Okay, so that means if you want to calculate, let's say, payment to creditors or collection from debtors, what exactly do we need to have? When it comes to the debtors, we need to have sales, we need to have opening balance, we need to have a closing balance. And do we have this? Okay, we have sales, we have the beginning balance somewhere given to us, debtors, and then we have an ending balance also. Amazing. So for debtors, we have everything. What about the creditors, guys? For creditors, you would be needing purchases. You would need opening balance and closing balance. Now my question is, do we have a purchase somewhere? They mentioned cost of sales. And we know that, okay, cost of goods sold. What would be the formula, guys? We can actually compute the purchases, right? If I'm not wrong. So if we focus on, since they are using the word gross margin, gross profit, so we will take it this as a cost of goods sold, not cost of sales. So we know the cost of goods sold is equal to opening stock plus purchases minus closing stock. Hence, purchases is equal to cost of goods sold minus opening stock plus closing stock. Is everyone okay with me now till this point? So, and we have the stock amount, right? We have the stock amount. Look at this. 1300 is the stock here. Cost of sales is given to us. And then the ending balance of the stock is also given. So let us do this. Let's understand. First, let's calculate purchases, guys. So my January COGS. So now these numbers 1635, 1405. This is coming from my income statement or from my P&L. Budgeted profit and loss. Now closing stock 1200, 1100 and 1000. From where we are taking this number? This is the information given to us for the ending, and the beginning inventory was 1300, right? Now I want you to see that my opening stock for the Feb will be the ending stock of January, guys. I hope everyone is pretty much straightforward on that. That part is common sense. You will generally have a closing stock and opening stock same, unless right on the night of the month end, there were some thieves dancing in the warehouse. You do not want to do that kind of assumption here. So we have the formula with us. That is, your purchases is COGS plus closing stock minus opening stock. So that is A plus B minus C, and hence the purchases are computed. Is everyone okay to calculate purchases here? All okay till purchases? Okay. Now, once we have purchases, it's a straightforward, quick ball. which we can pass like a musical chair. Like a purchases we have a creditors beginning balance and ending balance. Mind you, the beginning balance is given from the 1st January, ending balance is a lower abstract. And hence, from this, we can calculate, if you just simply don't want to rely on the formulas, we know our favorite T account, creditors account. You have the beginning balance here. You have the ending balance here. You have the purchases. And what we need to calculate is payments here. So beginning plus purchases minus ending. Guys, everyone okay for the payment to creditors also? Till payment to creditors, everyone okay? Now, similarly, if we create a debtors account T account here, we have a beginning balance, we have a sales, we have an ending balance, and we need to talk about receipts or collection here. So debtors, beginning balance plus sales minus the ending balance, we get the receipts from debtors. I hope all the calculations are crystal clear here. Because once we are clear on this, rest is history. We just need to be careful about the other account movements, especially the ones which are not reflected in the P&L, let's say investments or the dividends and all that, while preparing the cash budget, of course. Okay, so if we know all these numbers now, let's move to the preparation of the cash budget. But remember, all these balances, right? Short-term investments, movement. So we can ignore the the accounts for which we have already taken the movement. Debtors done, stock done, creditors done. But other aspects, right? Like dividends payable, wherever there is a movement, we need to incorporate that. Right? Either we are talking about payment of dividends, or we are talking about sale of investments, or we are talking about kind of making further investments. Abdul is asking, should we need to give note as assumed all? Abdul, that's absolutely fine, because they're not giving you any information with respect to the cash sales. You can say that, right? Good point. Piyush says, sir, this question is really tough to decide where to start from. Okay, Piyush, probably you're feeling that way right now, but when you do more practice, you will know the starting point, right? See, even if you prepare the cash budget and you're stuck, you will automatically prepare working notes. Geet says, with a change in debtors of 2 months, we can find the credit sales and cash sales. Don't know if required. Geet, the only thing is the proportion you have to assume otherwise, because with a general T account, you are talking about the beginning balance, ending balance, and the sales, right? On what basis you will be bifurcating that? That's what my point is. Because change in the debtor balances may not be only reflected by the credit sales. Could be because of the difference in collections also. Geet, I hope it is clear. Okay, so now let's move to the preparation of cash budget, guys. So for January, our opening cash balance is given to us somewhere on the top here, right? 545. So that's where we start from. And debtors collection, we just calculated 2070, total 2615. So payments are creditors. Now, where we are talking about expenses, guys. So let's go back. We see the expenses here, right? Can you see administrative, selling, and general expenses? 315, 270, 255. So 315 minus 60. 255, guys. Cash expenses, or we can say excluding depreciation. Now, are there any capital expenditure here? Plant. is 800 here in the month of January. The beginning value of the plant is 800. The ending balance of the plant is 800, no investment. But in the next 2 months, I can see investments and sales going on. No change in plant, but is there any change in any other account? Dividend and all? Nothing else, because 485 will be paid in the month of Feb. But look at the investments, guys. My investments had a beginning balance of 300. There is an ending balance of investment is 700, guys. So additional investment of 400 has been bought. So that's the purchase of investment. So hence, my total payments is 2300 and my total of the collections is 2615. So my closing balance becomes 315. Guys, get a quick confirmation here. Is January clear to all of you? January calculation is clear to all of you? Yeah. Now this 315 becomes the beginning balance of Feb, and the same aspect continues where we are focusing on the 315 is the beginning balance, and then debtors. Now, as I said, that investments became 300 to 700, 700 to nil. Look at the investments here, 700 to nil. So that means the entire investments are sold here. And that's what we are looking at, sale of investments, guys. So total is 2915. Payments from to creditors coming in from there. Expenses again were, I think, 270 minus 60 depreciation. Yes, Jyoti, whatever you want, like working note, presentation, everything is fine. Right? So expenses is done. And then we are looking at capital expenditure, right? So capital expenditure was there, 800 to 1600. Mind you, in the third month, there was a decrease from 1600 to 1550. So that means there was a sale of 50, right? So that will be seen in March. So definitely here it's like 800, and dividend is paid, 485 became nil, and hence our closing cash balance is 65, guys. That's about the February month. And then the same balance reflects as a beginning balance of the March, which involves the debtors collections 1850, sale of plant 50. Why sale of plant 50? Again, I'm repeating. My balance in the plant at the bottom has gone down from 1600 to 1550, guys. So sale by 50. So mind you, if there was a profit or loss on the sale, that would have reflected in the budgeted profit and loss, but we generally don't incorporate that into budgeted P&L. So we will not consider that, right? Okay, so creditors payments 1280 coming from our workings. Now expenses again 255 minus 60, excluding depreciation, and there are no capital expenditure. There was sale, dividends is not there, but in terms of the investments, guys, if you see, originally investment came from 300 to 700, 700 to nil, and now again 200, guys. That means you had purchased an investment of 200. So my closing balance becomes 290 here. And in this question, they have not given us anything with respect to the minimum balance or additional borrowings or deficit, so we can ignore that part. There is nothing of such sort is given to us for this one. Guys, all okay for this one as well? I think after doing 2 good exercises, you should be feeling good. Please confirm. Anything anyone wants to know, or all clear till now? Okay, great. Thanks, Jaspreet. Thanks, Alok, Ganesh, Sapna, Geet. Good, guys. Okay. So I think a couple of students were asking me, including Geet, about the investments and all that. Guys, I think you should also be, everyone should be also if not already created a profile, should be there on LinkedIn. There also, you can follow the communities with respect to investment and all, and get some knowledge before you actually want to go for that, right? So make sure that you guys are all on LinkedIn on professional platforms, right? There are websites like ET Money and all, which gives those guidance as well. Manoj, I agree with you. Manoj is a very, very interesting point. He says cash budget is purely logical, no formula needed. Manoj, I agree. There is no formula needed, right? Even the Cox formula is not a formula, it's a T account. 11th class trading account is the Cox, right? So I absolutely agree. Anyways, so that was a short period cash budget, guys. So in terms of the longer period, we generally are focusing on something kind of an adjustment to the profit and loss. So we are taking the cash and bank at the beginning of the year and then doing some adjustments. You add the profit before tax and add back the depreciation because it's a non-cash. Any sales from assets, capex is added, right? Proceeds from issue of shares. So it's like more of a coming to the cash flow statement, right? This is like investing activity. This is financing activity. Any reduction in working capital. This is anyways the indirect method of cash flow statement. Because any increase in the working capital would be a reduction here. This is nothing but in the indirect method. And Sharon says, please repeat one more time. Sharon, what do you want me to repeat? Which part? I hope you're not asking me to repeat the whole question, of course. Any specific thing you want to know in the last illustration? Be specific. Which portion was not clear? Basically, you have to understand the broad structure, Sharon, for that. To understand that, okay, receipts and payments, major source is debtors and creditors. For that, we did a separate working. Achha, you are not even asking. Oh, okay, let's just confirm, Sharon, please. If you're asking me about the last illustration on the current slide. So last illustration, we just did a very, very broad logical approach. First, we calculated the payment to creditors and the collection from debtors. And then looking at all the ledger accounts movements, we incorporated that into cash budget, whether it was a sale of investment, purchase of investment, payment of dividends, or purchase or sale of non-current assets. Right? So if you're talking about receipts, you just create a debtors account. Create a debtors account. Your beginning balance is on debit, sales is on debit, ending balance on credit, difference is the receipts. So we calculate the receipts from the debtors. And also we looked at other accounts like investments or plant to calculate what is the amount in the sale. You need to do this practice. You need to look at the balances on the question here. Okay, coming back to the long-term budget base. We were already discussing this. So we take the profit before tax, add back depreciation. We add the sale proceeds. We add any kind of a share issue. We do the indirect method adjustment, like add a reduction in working capital or less or reduce the increase in working capital. Then any dividends and taxes which are not there in P&L, any purchases of the assets, and any redemption. So it's like more of a cash flow statement, nothing else. So obviously, cash budget for long period would be like more of a budgeted cash flow statement. You guys are absolutely spot on, right? So there is a quick illustration here for us, again from your study material only, which is talking about cash flow with respect to the longer period, right? So let's have a quick look on this illustration. So we're talking about the P&L for 2 years, year 1 and year 2. Opening stock, raw materials, stores, a lot of manufacturing expenses, depreciation, all expenses are given, sales, closing stock, and they've given you straight away the net profit. Now, they're saying that sales are expected to be 12 crores, right? They're about 12 crores in year 3. So if we talk about year 3 here, it's a good jump from 8 to 10, 10 to 12. That's what they're telling us. As a result, other expenses will increase by 50 lakhs besides other charges. Okay, so this part is being talked about of here. only raw materials are in stock. Okay. We are talking about assuming sales and purchases are in cash terms, and the closing stock, when we say assume the sales and purchases in cash terms, assume the closing stock is expected. Now, this is very important line, guys. I want everyone to concentrate on this. Closing stock is expected to go up by the same amount as between 1 and 2. Same amount as between 1 and 2. Okay. That means we need to see what is the movement in the closing stock. Also, you may assume that no dividend is being paid. Now, with respect to no dividends being paid, of course, that doesn't require any adjustment with respect to the outflow. And then we are looking at the company can use 75% of the cash generated to service a loan. Compute how much cash from operations will be available in year 3 for the purpose. That's what we need to calculate here. So if we want to compare year 2 and year 3, one thing is for sure that sales is going up by 2 crores. They have given nothing with respect to the miscellaneous income, so we can include that 10 lakhs. Now, a very, very important aspect is they're talking about only raw materials are in stock. Now, if there are raw materials in stock, and they're saying that the closing stock is expected to go by the same amount as between year 1 and 2, you guys say that, okay, it is 50 lakhs. Some of the people say that, okay, it's 50 lakhs. Now, can we also calculate what is the consumption in terms of the raw materials? That's also important to understand. Anyone? See, what we are doing here is, before we actually prepare the cash flow statement or projected cash flow for the entire year 3, we need to calculate or kind of project the profit for the year 3. Am I correct? That is my starting point, right, guys? My starting point is profit before tax and add back depreciation. So I need to go to that level first. Now that means in year 2, what was my material consumed, guys? In year 2, okay, we can start with year 1 also. 80 lakhs plus 3 crores minus 1 crore, so 280. What is in year 2, guys? What was in year 2? 350. All okay, guys? Any thoughts? Any thoughts till now? So if we are looking at year 2, I have a 1 crore opening stock plus 4 crore minus 1.5 crore. 3.5 crore, which is nothing but approximately 35% of sales. Now, since only raw materials are in stock, and they're saying that the closing stock is expected to go by the same amount as between year 1 and 2. But the only problem is there has been a jump in the sales also. Now, if we are only increasing the closing stock, do you agree that then we do not know how much is the opening, okay, opening stock for a moment, we can still imagine that, okay, it's a closing stock for the year 2, but what would be the purchases? Can we rather take the consumption amount? Guys, do you agree with me? We do not know anything about the purchases here. Everyone okay here? We just computed that, okay, in year 2, there is a raw material consumed 35% of my sales. And with that process, we can easily say that the raw material consumed, if we say the same ratio, guys, mind you, even year 1 had 35%, because 2.8 crores divided by 8, right? 35%. So it has been 35% constantly. So can we say that means my raw material consumed has been same amount, means like same consumption? If the raw material was increased by the same amount, consumption would have been the same also. So my raw material consumed for year 3 would have been 35%. 35% of 12 crores is how much, guys? Looks to be a 4.2 crores. This is the most important point of this illustration, guys. 4.2 crores. Similarly, stores would also increase by the same, guys. If my ratio, if I am creating the, Sharon says I'm not getting. Sharon, what happened? Sharon, you just need to understand that what is the formula for material consumed. Opening stock plus, purchases minus closing stock. So we are just kind of calculating the percentage. The percentage for year 2 was my cost of raw materials consumed, which is 3.5 upon 10 crores. So 35% we calculated. Now, if my sales is jumping by 20%, similarly, my stores will also jump by 20%. My manufacturing expenses will be also jumping by 20%. But other expenses, they're specifically given to us, will be a 1.5 crores. That's what they're given to us for other expenses. And depreciation, I don't believe that there needs to be any change in absence of any other information. Geet, yeah, you can do that. Geet says that purchases would be 3.7 because you are talking about the closing stock, or you could straight away so say the material consumed, right, Geet? So what we can do is, if you see the next this slide on the screen now, we are just comparing year 2 and year 3 now. My sales was, now these numbers are in lakhs just to avoid zeros. My sales have gone by 20% here. No change in the miscellaneous income. Material consumed, this is what I was explaining in the last 10 minutes, guys. Materials consumed. How did we arrive? 35%. 35%, Sharon, 35% of sales. Stores, 20% up. We are talking about manufacturing expenses, 20% up. Or you could have taken a ratio of the sales also, right? Like you can see in the notes below. You could see a ratio of the sales. That's okay. One and the same thing. Other expenses given to you. Depreciation would be same. So we have a net profit. That's my starting point for the cash budget, guys. And someone was asking me about what about they have given for the increase in stock. That we will be incorporating in the cash budget now. Because we did not have purchases. So increase in stock is given to us, right? 50 lakhs or whatever. So once we get to our profit of 204, we can then move to making a projected cash flow statement for the year. So that 204 straightforward goes there. So my 204 straightforward goes as a starting point. We add the depreciation and look at that. That's the increase in stock here. That's the increase in stock. So that is a reduction for increase in working capital. And they had given in the question that 75% of the cash is, can be used for servicing the loan. So that means you want to keep 25% of the cash with you, 75% can be used for repayment of the loan. Dinesh says, why closing stock is not considered? Because Dinesh, we we had to calculate our material consumed in the same proportion, right? So closing stock anyways is 50. So remaining would be the purchases either ways. My material consumed is 420. Someone says that, okay, why the closing stock is not calculated? I can use that. So if my cost of sales is 420, Dinesh, and when we are looking at the opening stock, my opening stock is how much? 150, right? Plus purchases minus closing stock. And the closing stock, they say that, okay, the same amount could be 200. Hence, your purchases could be the balancing figure. Does make sense to everyone? Geet, I will tell you. Okay. I hope, Dinesh, that is clear. Geet, 50 lakhs is already there in the other expenses now. 100 to 150, that is already incorporated in the reduced profit of 204. Okay, Piyush says manufacturing expense is increased by 60% in year 1 to year 2. Increase in sale is 25%. Okay. However, when you are talking about year 3 numbers, right? We are looking at the same proportion here. I agree with your point, but we cannot base year 3 number on year 1. Good observation, Piyush. We'll be basing our assumption on year 2 and not year 1, right? Okay, so guys, this is a little tricky. I know this is a very tricky example because we have to incorporate our material consumed as an, I would say, computed number or balancing figure, however you want to take it. But what we need to understand that, yes, this is a very, very, I would say, mini example. If we talk about a really a long-term cash budget, that would actually take the form of a cash flow statement. Nothing but cash flow statement. I think there could be a lot more observations on this particular question because specifically you don't have all other information, right? Investing activities, financing activities. So all that has to be given to make it a complete calculation, right? We are not even given all the information. So this is just a mini question, I would say. Jasprit says, please explain 50 lakhs deducted from profit before tax and okay. Jasprit, because increase in current assets is a reduction, na? Indirect method. Jasprit, increase in current assets is a reduction, indirect method. Sharon says, why we are not including opening stock while calculating raw material? Sharon, we have already incorporated that in the material consumed. Sharon, material consumed is opening stock plus purchases minus closing stock. The word is material consumed here. Everyone okay? Okay. So guys, I think it's 7:25 now. We have like, I think we very, very urgently need a break. I guess many of us, it's almost like break due for last 5-7 minutes. So let's take a 10 minutes break now. Let's freshen ourselves. And we had a good exercise of cash budgets till now. When we come back, we will talk about some more important exercises with respect to some management techniques with respect to the cash collection, receivables part as well. So let's take a 10 minutes break and be right back. Okay, guys. So, welcome back. So, each one is back after the much required break. Before the break, I had a question from Alok. Alok, I had already answered, why we had included the 50 lakhs into the cash flow statement, because you remember the increase or decrease in the working capital. So, this is an increase in working capital, right? So, increase in current assets is a reduction. So, that's why we were kind of reducing it. Anyway, so now we move on to the next aspect. It's a very, very important aspect, which is like managing the cash collections. How can we expedite the receivables management or receivables payments in terms of aligning with our vendor payments? So whatever the receivables our debtors have to pay us, can we expedite that? Right. First, we need to understand that yes, more from a cash management perspective, it's always an ironical situation that if we need to manage our cash receipts and payments, we want to accelerate, we want to speed up our collections. At the same time, we want to defer the payments. As long as we do not miss any deadlines, it's all fair game. Now, first we talk about in terms of the receivables. You can see on the screen that there are often delays between the sales and the realization of funds. I'm not talking about the credit period, mind you here. Of course, credit period is definitely the period you are anyways, giving to the debtors. But what we need to also understand is there are 4 types of floats, or rather spreads, which could lead to a little bit of a delay. What are these floats, right? First one is the billing float. Now, mind you, a slight difference between theoretical and practical understanding. Now, practically, most of the corporates are into ERP systems and integrated module management. Practically, you have online payments these days, digital payments. So some of these is more from a perspective where those facilities are not available, right? So don't mix it up like, okay, this is not the common anymore. You may have certain cities, states where those facilities are not there. So billing float, time between sale of goods and mailing of invoice. Now you may wonder that generally if you from a purchasing standpoint, if you purchase the goods, generally the invoice is along with the goods, right? You would assume that. But what I'm trying to say is that if at all it is not there, that means this is the internal process delay. You are selling the goods, but you're not, mailing the invoice. Now, these days, if you do any online shopping on, Flipkart, Amazon, you immediately get the invoice on your email or the order confirmation, and also the invoice hard copy is there in that parcel as well, right? But still, if at all in some companies there are inefficiencies that you're selling the goods but you're not mailing the invoice simultaneously, that gap is called as a billing float. As the name suggests, billing may delay. Now then we are talking about mail float. Now this is more from a perspective of those cases where still a debtor is paying or making the payment by check. And not only by check, but also they are sending the check by courier. These days you can argue that, sir, who pays by check? It's online payment. Someone can argue, sir, who is couriering the check? You can directly, the customer can directly deposit in your account. Now, still, if there are situations where the customer is giving the check to the courier agency, that time which is involved in taken by that delivery agency here, which is carrying our check, is mail float, right? The time taken by the mail. Now, check processing is another internal process inefficiencies. Let's say if you have received the check, but you are taking a day. Let's say one day all the check collections are done and the next day you are recording it in your books, right? So time taken to record and deposit. So you're just keeping the check with yourself. You may laugh, who does that, right? It's like process inefficiencies. So you can, half of it you can solve it by just making sure that it is all robust, it's all automated. So check processing float, wherein you take time to deposit the check. And the last one is bank processing float. I think this is, everyone understands this, right? You deposit a check today by, let's say, before 11 a.m. By tomorrow, end of the day, it would be cleared. But if you are delaying the check deposit today, it may be getting cleared, let's say, on a Thursday or a Friday, depending on which bank it is. So at least 1 to 2 days is bare minimum time. That's bank processing float. Now, in terms of the collection management, the idea is to kind of speed up these issues Of course, couple of floats you can see, that is billing float and check processing float, is all internal issues, which you can easily solve it by simultaneously sending the invoice and also ensuring that if at all you are collecting a check, it is deposited immediately. Mail float, of course, it is more with respect to the directions you are giving to your debtors, how they can directly deposit that check, or they can resort to the latest online banking system, right? And bank processing, of course, is something you really cannot much avoid, right? That's the least avoidable one though. So now we are talking about a couple of systems which are directed towards this. One is called concentration banking, where what you can do is that you could have one major bank which could be at your head office, whereas there could be multiple collection centers in different locations where those checks could be collected. The customers can be directed that, okay, you have to deposit the check with so branch. This is the account number. This could help to reduce that mail flow. Those of the customers who are kind of sending the checks by courier. Jaspreet says NEFT and IMPS effects. Yes, of course, absolutely, Jaspreet, perfect. So as I said, in the present day scenario, you will hardly see any of these floats, probably bank processing float. That's what I initially said, right? Logbox system. Now, logbox system is a very, very interesting service, which is still prevalent, especially in international countries as well. Where you contact bank, you pay some charges for that. So basically, you are renting a kind of a box, post office box with the bank. You authorize the bank in those locations to pick up the remittances in those boxes. So customers are given the address of those boxes, where the remittances are sent, and the bank service person or the employee will open that box multiple times in the days to check what are the any checks in over there, and this would definitely help to reduce the check processing float, where you are keeping the check with yourself in your drawer and so on. Deferring the payments is the other aspect. Deferring the payment is like where you are wanting to delay the payment to the last credit day available by you, right? Now there's a very, very interesting illustration, guys. I don't know if this is the still page number, same page number. Can anyone confirm here? Illustration 9 named as Prachi Limited. I want to give you that as a homework. Can you just confirm a page number here, guys? A illustration which starts with Prachi Limited, wherein it is telling you what is happening on different weekdays, right? You are giving some check on Monday, getting cleared on Wednesday, something is happening on Tuesday, Thursday. So that illustration is of different weekdays: Monday, Tuesday, Wednesday, Thursday, Friday. Something or the other thing is happening on every day. And they are telling you that, okay, at the end of the week, what are the checks which are cleared, what are still under process. It's a very, very basic, I would say, illustration which just requires your understanding of the calendar days and the time. That's it. And that's why I want you to, okay, it's 10.52. Great. Thanks, Abdul. Thanks, Alok, Ganesh, everyone. So 10.52. So you can please make a note of it and do a reading for sure. It will expand your understanding. I know some of you might be thinking that it's not practically relevant, but guys, you never know that, sometimes in some cities or in some regions, tier 3, tier 4 areas, where some of these could be still applicable. Right. So my humble advice would be just to read that illustration later on. Right. So there are other techniques also with respect to the cash management. And most of these you know already, right? Electronic fund transfer. You know that, right? Quick transfer of funds. I'm sure we all use digital funds these days, right? Paytm or Google Pay and so on. Zero balance account. Now, this is something which is arrangements with the financial institutions. Also, you talk about investing in marketable securities, where you don't want to kind of keep any kind of a minimum balance. Money market operations, where you are investing for some days, like we discussed, right? We talk about bargaining with the bank for some rates. Electronic cash management system, where is ease of facilitating the banking with the help of a net banking. That is definitely is very, very helpful. Virtual banking. Now guys, I hope everyone understands what is the artificial intelligence and robotics. So long back, you would have seen that when you go to ATMs, let's say you are wanting to even update your passbook right now. Again, it's a debatable point. Some people may say that, okay, there is no need of updating the passbook. The statement can be extracted anytime from net banking. That's okay. But talk to your parents, right? There are people in the family who still believe in getting their passbooks updated regularly. Am I correct? You have your parents, grandparents, I'm sure they would have still those their old traditional systems and beliefs which they want to carry to get a good paper trail of everything. And if you go to those bank branches, most of the bank branches are more or less automated in terms of that you have to just insert the passbook and there is some kind of a connection, or it takes, in certain banks it's instantaneously, there is a clear cut printing kind of a voice and the passbook comes out, some additional lines, right? So virtual banking and think about your even through Paytm and all, you have those codes, right? You scan a code, you make a payment, you talk, even these days, even auto rickshaws and everyone is carrying those because they don't have the change sometimes, right? And apart from this, I think okay, Dinesh says it is also available in the village. So great. So basically we are looking at everything is available, right? So even sometimes you want to call it the customer care, everything is like customized even over there with some I would say menu items, and you can take a help, regenerate pin codes and everything. So it's, a lot of things have changed over the time period. Now, management of marketable securities is one piece case. So we already discussed some part. Yes, Sapna says bar passbook. Yeah, I think Sapna, that reminds me, I don't know if anyone has actually got that experience in the last 3-4 years. I'm sure someone would have faced that, where you or your parents would have gone through to the branch and getting a passbook updated, and they said that this passbook will not be updated now. You have to get a new passbook with a barcode. And this was a transformation when I think originally the old passbooks used to get updated by the person sitting over there. But if you want to get an automated updated, you need to get that barcode based passbook. Thanks for that input, Sapna. I think everyone is aware, I hope, of that change which happened with the automation. Great. So in terms of management of marketable securities, we took an example today wherein we discussed that, okay, hey, surplus funds could be invested in the marketable securities, and that could be liquidated as and when required. And there are certain good examples here, because you don't want to take too much risk over there, right? If you're wanting to invest in the marketable securities, you do not want to take too much risk. So you may go for a government treasury bills or deposits with banks, very rarely with other corporations also. And the idea is that you don't want to take risk. That means you want to ensure the safety here. Risk is minimum. Maturity, of course, could be matched. Like you want to have a short term, very, very short term, because you want to map your forecasted needs of the payment. You would need that, okay, after 6 days, you need funds. Marketability, of course, you don't want to spend in something where there is a lock-in period, right? So convenience, speed, and cost, easily where it could be sold. So all those are good principles which, with respect to help us to understand, okay, the marketable securities also is a good source of having the surplus funds invested. Now, let's take an example of a company wherein we will be talking about some cash conversion cycles and all, and how much we can save in terms of adequately investing the funds, and how you want to analyze this. So this illustration on the next slide, which is with respect to the Shri Bhakti company. I want everyone to read the information, please. So on an average, debtors are collected after 45 days. Inventory have an average holding period of 75 days. Creditors payment period is 30 days. Everyone is like super excited right now, thinking of operating cycle, right? That may or may not be the requirement here. Firm spends a total of 150 lakhs annually at a constant rate, and it can earn 12% on investments. Very good. From the above information, can you calculate cash cycle and cash flow? Like just like we discussed, operating cycle, guys. Can anyone tell me cash? Do you remember I told you gross operating cycle and the cash conversion cycle. So the operating cycle we generally calculate in terms of reducing the customer's time is also called as cash conversion cycle. I hope you remember that. I told you we also calculate, we also call it as a cash conversion cycle. So what is a cash conversion cycle here? And you can also give me an idea about, how many, number of cycles there are in a year. So that is basically called as a cash turnover, right? So what would be the answer? Okay, Alok gives me an answer that, okay, it's like pretty straightforward. We are looking at 45 days plus 75 days minus 30 days. That's 120 minus 30, 90 days. And if we are talking about 360 days, so 360 divided by 90, so 4, right? So cash turnover or cash number of cash operating cycles are 4. So 90 days and 4 would be the answer, right? Some people are saying 120 days. No, 120 minus 30, na? You will also reduce the creditors period, guys. So we're looking at a 45 plus 75 minus 30. So 360 upon 94. Now, minimum amounts of cash to be maintained to meet the payments as they become due. Now, what we're looking at is that how much are we spending totally, guys? 150 lakhs annually at a constant rate. So that means if 150 lakhs is the annual spend, how much cash cycles we have? So that means we would need to have a 37.5 lakhs cash, because we are having like four cycles. 37.5, guys. Everyone agreeing with that? Everyone okay with that? 37.5. Now, the third requirement of this question is very, very different. Savings by reducing. Now, savings in what? Savings, of course, in terms of any, reduced funds, and what you could earn interest on that. So 37.5 lakhs is you need, but now they're saying that, okay, things have changed. The average inventory holding time is not 75 days, but 30 days. If that is the case, I do not anyhow remember that I do not need to have 90 days, because now it's a 45 days. So it's my cash cycle is reduced from a 90 day to 60 days. Everyone okay, guys? Because reducing the average inventory holding by 30. So the word is by here. So that means my operating cycle is a 60-day now. And hence we will have a 6 operating cycles or cash conversion cycles, I would say. And therefore, we would be at a particular point of time, we would be needing 150 upon 6, 25 lakhs. Instead of 37.5, we would be needing 25 lakhs. So additional 12.5, which was required, is no longer required. So that means it's like, you are talking about a savings of 12,50,000, which could be invested in the market at 12%. That is 1,50,000 here. That's my savings. Everyone understood this one? Very, very simple, but interesting illustration, kind of evaluating different scenarios. I hope all okay here. Great. Very good. Okay, so now we also talk about a very, very interesting exercise with respect to something called traditional models on cash management. Traditional models on cash management. And there could be multiple models, but we are talking about two major models. One is a William Baumol's model, which is like based on our EOQ of inventory. Right. So where it now in inventory, there is an EOQ model which talks about that, hey, we need to create a balance between the inventory level so that we can balance the ordering cost and carrying cost. Similarly, here, what we're looking at is that in terms of carrying cost, if you're carrying too much of a cash, there is an opportunity cost attached, right? You will lose on the investment if you like carrying the cost, cash and not investing somewhere, or transaction cost. Let's say every time you have to break up something. So you don't want to end up into a surplus or deficiency. If there is a deficiency, if you're falling short, you want to liquidate the investments, you end up incurring some cost. So idea is that we need to maintain that level of cash where the carrying cost and the transaction costs are minimum, are in balance. Abdul is sharing the formula here, right? So you're talking about same formula of EOQ. We're talking about 2 into, depending on annual cash disbursement multiplied by, your fixed cost per transaction or your ordering cost, whatever. In this sense, it will be an opportunity cost and divided by your opportunity cost. So basically, again, what we're talking about 2 into, annual requirements. Now that could be monthly also. And when you multiply this with the fixed cost per transaction and dividing that by opportunity cost. So guys, this is the same formula, and we will be talking about EOQ later in the inventory management. I'm sure you guys have already done in costing as well. So the assumptions in this model is also similar, wherein like we talk about like holding costs, transaction costs, or opportunity costs are kind of constant, they are known. So we can talk about it endlessly, but we need to know this model. In case you are there to attempt a theoretical question, you should know that the crux of the model is that you need to come out to an optimal level where there is a carrying cost and the opportunity cost, which is like, or rather transaction cost, are minimum, because carrying cost is nothing but opportunity cost here. Now, the second model, which is a very, very interesting one, which we saw earlier in that graph, which is a Miller cash management model, Miller or cash management model, which is kind of a, I don't know, like anyone is aware of something like, let me give an example, practical example. If all of your households have something called like a motor, water motor, where you have some levels of, a minimum level or tank full or something like that. Are you guys aware of water motor being installed in many places these days, right? And I think it's like almost for a decade now, wherein the motor trigger where the water tank has the balance at a minimum level, the motor gets switched on, and once it is almost full or wherever the full mark is, it gets switched off. Have you even heard about that? I'm sure many of you would have even seen that, right? Some people have that kind of alarm system where it kind of gives a sound that, okay, the water tank is full or whatever. Now this model is very, very similar to that. We are talking about 3 limits of cash here. One is upper limit, which is reflected by H. We talk about a return point, which is Z, and lower limit. Now, which is like as a 0. Now, which is like a lower number than a Z. Now, what we're looking at is when balance reaches H, the upper limit, when the balance reaches H, an amount H minus Z here, this gap, is invested here. This amount gets invested in marketable securities. So basically, we're looking at a surplus being invested. But when it comes to the lower limit, when it touches down 0 here, then of course, you have to liquidate some investments. And the idea is you want to carry some balance, right? Either exactly the return point or near to return point. But if your balance is between these three limits, I would say somewhere here, then no action is required. No action is required. Very good model, but again, based on the cash budget only. I think the first example of the cash budget we did, we actually did exactly that. Remember 20,000 balance thing? I hope you remember that, guys. The first example, that's what we actually did, right? So these are the two good models here. Now, we also talk about management of receivables in terms of the steps which can be done for collections and all. Of course, receivables management is all about what is the money owed to you. And remember my discussion earlier, Abdul says a peak and recession. Abdul, not the correct word though, but yeah, higher limit and the lower level, I would say. Yeah, so you remember the liquidity and profitability trade-off. Right? So if you are talking about lenient credit policy, that means large receivables, more sales. But the problem is that there could be risk of bad debts. There could be higher cost of collection and opportunity cost, of course. Remember, the money which is stuck in the debtors, don't forget that. It's not the sales. We discussed cash cost, right? If you're talking about low receivables, that means strict credit policy. That means people can go to the competitors. So it's a trade-off between the profitability and the liquidity we already discussed. Now, three aspects of receivable management. Of course, we know these very well. First one is credit policy, which I was just explaining you. That is a trade-off between the profits on additional sales and the cost of carrying those debtors. On the other hand, you want to additional sales, which is like more of a getting the credit extended. They are happy, but you are also incurring the cost. Now, I already told you the example of a credit period or a credit policy, which is mentioned in the agreement. Like they're given 2/10 net 30, which means the credit period is 30 days. But if they pay you within 10 days, they will get 2% discount. Right? Now, what kind of a credit policy you would have, right? If I give you three options, okay, you want to give 15 days, 30 days, 45 days. Guys, if I just give you three options, blankly, I'm giving you three options, 15 days, 30 days, 45 days. What will be your response? Which policy should I go with? Which policy should I go with? 15 days, 30 days, 45 days? Any answers? Someone says 15, someone says 30. But guys, don't you think you should have asked me, sir, is that the only information available? Probably you would want me that, sir, what will be the sales level at different policies? What will be the bad debts? Don't you think so? In a nutshell, whichever policy will give me the maximum benefit, I will go for it. Guys, opportunity cost should also be considered. So you should have cross-questioned me, right? What about the other information? So whichever policy, now the next step we'll be discussing on the credit policy evaluations, don't worry. So we'll talk about the credit policy evaluation after this. So credit policy is one. Other is the credit analysis or due diligence. Now this is important, especially when you interact with the customer the first time. You want to check the customer background, right? If the customer has been a troublesome for the market or has been a really a good reputation, risk analysis, your past experience, all those is credit analysis, also called as a due diligence. Now the third is control of receivables. Now this is something, guys, like why we talk about the managing floats. Similarly here, internally, what can we do? We can do an aging analysis. We can do follow-ups, right? We can do follow-ups. We can, probably have a separate collections team. We can even outsource it, right? So a lot of things. So these three aspects are very important, guys. Now we talk about the first one though. Valuation policies now. I want everyone to be really attentive. This happens to be the last part of the day, but this will take some time, right? I need around a good 20-25 minutes of concentration of everyone here. Now, when we are looking at a evaluation of credit policy, there are two approaches given in your books. And I will tell you the difference between these two approaches. One is a total or a gross approach. Now, what we're discussing here is, guys, whichever policy is giving me the maximum benefit. Simple answer, right? So let us see this information one by one. Now, let's say we have different policy. Let's say my present policy is 30 days. Okay, so this is not so visible. Let me change the color. Let's say the present policy is 30 days and the proposed policies are 15, 45, or even 60. So these are proposed, right? So you have a credit sales here. Now, total cost other than bad debts and cash discounts, so whatever the total cost, variable cost, because see, variable cost at a total level will change. This will go either up or down. But the fixed cost will not change unless you are breaching the capacity constraints. Fixed cost will remain constant. So how do we be careful about the fixed cost base? That what you should do is, you should see what is the fixed cost under the current policy base. Whatever the number of units in the current policy, that multiplied by fixed cost per unit should be your total fixed cost. And that fixed cost will not change until and unless they tell you that beyond a level, you need some additional investment. So what are we looking at? Credit sales, cost other than bad debts, variable cost, fixed cost, and then bad debts is mentioned separately here. Cash discount also, whatever the expected cash discount is because of the credit terms. Now, point number E is expected net profit before tax. A minus B minus C minus D. Whatever we have talked till now, we have discussed expected net profit before tax. And then, of course, there is a tax. So this is expected profit after tax. Now, this is not only the end, right? What we need to also consider is opportunity cost. This is important. Mind you, if you are increasing the credit period, especially, your sales will go up, right? If sales will go up, you would need more funds. You will have higher receivables. Your cost of investments in receivables, those are locked up. You would have invested that somewhere else. If that money was with you, you could have invested somewhere else. Guys, getting it? So that cost is an opportunity cost here. You will also reduce that under present scenario 1, 2, 3 as well. Proposed policies as well. Now, what will be my decision, guys? If I follow a total approach, whichever gives the maximum net benefit. Do you agree with me? Whichever gives is the maximum net benefit. Yeah. So now let's see another approach. How can we present this information, alternatively? This is the incremental approach, guys. In incremental approach, every number is presented on an incremental basis. So, for example, you have a present scenario here, credit sales. You can see what is the incremental credit sales. So on the top, you have credit sales, but the incremental credit sales will be only additional here. In proposed policies 1, 2, 3, everything is incremental. Look at this: incremental credit sales, incremental cost. Now, fixed variable cost will be incremental, of course, but what will be the incremental fixed cost, guys? Do you agree that if there is no capacity issue, the incremental fixed cost would be 0? Incremental fixed cost would be 0. Unless you have additional investment given to you. Incremental bad debts, if my bad debts are increasing. So let's say my current bad debts is 10,000. The next is 12, then 14, then 16. So it will be 2, 4, 6. incremental is not 1 minus like 2 minus 1, 3 minus 2. No, it's with respect to your present policy, guys. Incremental here means proposed policy minus present policy. Proposed policy 2 minus present policy. Everything minus present policy. That's incremental. Incremental cash discount, everything is like pretty much same. Look at this. Incremental expected profit after tax. The word incremental is prefix. That's it. Geet says in NPV and Geet, absolutely correct. I think you would call it as anyways, right? Now look at point number B, guys. Required return on incremental investment. Now, of course, you're looking at cost of credit sales, collection period, and whatever the investment in receivable is there. So point number C was anyways being done in the total approach. You need to know what is the receivables. And hence there is the word incremental investment in receivables. And the opportunity cost also is incremental. So this is what the calculation is with respect to the opportunity cost. Okay. I'm sure things get more clearer when we provide numbers to the words, right? I'm sure everyone agree with that. Things become more clearer and interesting if we actually practice something out. And I'm sure everyone wants to do that. So let's do an illustration quickly before we call it off. Let's look at this illustration, guys. I want everyone to be attentive. Only 15 minutes, guys. That's it. What I want your concentration for the day. A trader whose current sales are in the region of 6 lakhs per annum. Average collection period is 30 days. Wants to pursue a more liberal policy. They've given a study based by the management consultant. And they're giving you the increase in the collection period. 30 days. Okay. So they're looking like this is 40 days. This is 50 days. This is 60 days. And this is 75 days. Because this is increase in collection period. Increase in sales. They've already given you increase, right? That's interesting. So incremental ke liye, the data is there already. Incremental. So 6 lakhs 30,000. 6.48. 6.75 or 6.9. But the point is your bad debts is the issue. And they're giving you a selling price of 3. Average cost is 2.25. Variable cost is also given, guys. Wow. And the current bad debt is 1%. Is there something which will not change, guys, irrespective of the policies? I think that's my fixed cost. So who can tell me the fixed cost, guys? What is the fixed cost here? Who will tell me that? Mind you, the average cost per unit is given you 2.25 and the variable cost is 2. So what is the answer here? What is the fixed cost? Okay, but tell me the total amount, guys. Many of us saying 0.25. That's per unit, right? So what will be the total fixed cost? Only one answer coming in from Sapna. She says 50,000. So guys, do you agree what I've done at the bottom here? 0.55, okay, but my sales is 6 lakhs now. So 0.25 upon 3 into 6 lakhs. Just how come 7,500? 50,000 over, right? 0.25 per unit. Na? So sales is given to you 6 lakhs. Or you can do one thing is like 6 lakhs divided by 3. You can say what is the total number of units is 2 lakhs, right? So 2 lakhs into 0.25, whatever you want to do. You can calculate number of units first. That's okay. Okay, so everyone is coming with 50,000 here now. Let's look to our calculation or comparison of different credit policies now. I hope everyone is comfortable with the numbers here. In case you want to keep the numbers in front of you, take a snapshot of this slide. And then we can move to the next slide and we can look the numbers. How do we fit in different policies? Right. So let's say first let's focus on what is happening in the present. So we are looking at a total approach. Presently, we are looking at credit sales is 6 lakhs. Great. Now, variable cost was how much, guys? 2, right? So 2 is my variable cost. If 3 is my selling price, so 2 by 3 is my variable cost. 4 lakhs. Mind you, fixed cost will remain constant. I hope everyone understood 2 per unit, but my selling price is 3. So 2 by 3 into sales. The total cost is 4,50,000. Bad debts was 1%, right? Existing May, there was 1%. 6,000. Expected profit is 6 minus 450 is 1,50,000 minus 6 is 1,44,000. Now, how do we calculate this opportunity cost in this case? Of course, is we are looking at the cost involved here. So cost involved is 4,50,000 and 20% is the rate of return and the credit period is 30 days, right? 30 divided by 360. So we're looking at a 7,500 opportunity cost. I want everyone to confirm me if the calculation of 7,500 is clear or not. My cost involved in this level of sales, like cost of investments and receivables, like we're looking at 4,50,000 is the cost for the entire amount which I've sold. That multiplied by 20% for 30 days. Yes, Geet, cash cost. So 7,500 is the amount here. Okay, I'm just 7,500, not 75,000. Okay, now let's move to the next policy, guys. 40 days. For the 40 days, we already saw in the last one that my sales has gone up to 6,30,000 and bad debt has increased, right? So 630. 2 by 3 of the sales is variable cost, 420. Fixed cost remains same. So my total cost is 470 now. Bad debts is 1.5% of 6,30,000. So 9,450. And my expected profit is increased to 150. However, there is also a increase in opportunity cost because you have larger cost now. 4,70,000 into 20%, but this time it is 40 days. Blockage is for 40 days, which is like 10,444. Now, whereas my net benefits in the under the existing policy was 1,36,000, it has increased to 1,40,000, guys. It looks good right now, but we are yet to evaluate the other policies also. So my net benefit is increased under the 40 days proposed policy. Guys, all okay for 40 days? I hope 40 days is clear to everyone. 40 days policy. Okay, we move to the 50 days scenario now. In 50 days, what has happened, guys? Sales increased to 648, bad debts is 2%. Okay. So this is a sales level, 648. 2 by 3 of sales is my variable cost. That's the same ratio. Fixed cost, no change. So total cost is now 482, mind you. Bad debts is 2% of 648, is 12,960. Expected profit, wow, it has increased from 150 to 153. But the problem I can see here is the opportunity cost is slightly increased further. opportunity cost, guys. 482 is the cost for 50 days now. And that is why, since my opportunity cost has also gone up, my profit has also gone up. At the end of the day, I see my net benefit is like slightly lesser than 140 days. It's 1,39,000. It's 1,39,000. My 4,82,000 cost was blocked for 50 days. So 20% rate gives me an opportunity cost of 13,389. Now, intentionally, there is a question, how is the bad debt increasing? Because, sir, there is a information, guys, given in the question. Default anticipated 1.5, 2%, 3%, 4%. That percentage is of sales, of course. So that is given to us in the question itself. That's why we are applying that percentage, guys. Now, I'm intentionally going to the last policy right now, so that I want to just to show you the incremental approach also. 60 days policy, you can please refer to later on. I'm moving on to 75 days policy, guys. 75 days policy has a sales of 6,90,000 and the bad debt is huge. So Partha, the bad debt is 4% here at 6,90,000. So 690 is my sales, 460 is my variable cost, 2 by 3. Fixed cost, there is no change. So the total cost now blocked is 510. But the bad debt is huge, 4% of 690. Geet, right now it's not about solving a question. Right now, this illustration we are just using to show you both the methods. Geet was asking why didn't we use incremental straight away? Geet, I'm just showing you both the approaches, right? If the question tells you which approach to be used, you can follow that, else it's up to you. And then you can mention your assumptions. Okay, so now my profit has definitely gone down, 152 here. And look at the cost blocked 5,10,000 for 20% for 75 days. My opportunity cost is huge, 21. Can you see in proposed policy D, my benefit has even gone down from the present policy. So if I compare all the policies, I can see policy A. Policy A is the best policy, am I correct? Net benefits. Policy A is the best policy, guys. Everyone agree? I think policy B was closer to that, but policy A is the best one, right? I think there is hardly like 450 something difference between policy A and B. Now, if we look at same example, like Geet is saying, incremental approach. So last slide of the day is the next one. We're looking at the incremental approach. Now look at the left-hand side, guys. We are only talking about the incremental sales here. If you're looking at the incremental sales, 30,000. Now this incremental is from the present, not from the previous policy, right? So 6 lakhs to 630 is 30. 6 lakhs to 648 is 48. It's all incremental. Similarly, the variable costs are only incremental. Fixed cost you can see is big 0 here, as we discussed. And Geet, let me tell you, for calculating incremental, you need to do some gross calculations anyways. Now look at incremental bad debts. You anyways need to calculate the bad debts amount on those gross numbers. So 6,000 say 9,450, 6,000 to 12,960. Right? So you need to calculate those gross amounts to get to the incremental bad debts. Everything is given incremental way. It's not from the previous one, I would say. It's about from the original, from the present policy. Now, incremental benefit I can see right now is coming in from policy A 6550, policy B 9050. Right now, interestingly, in the incremental, where we are looking at policy C giving a maximum incremental benefit. Amazing. But will it give the same conclusion? I don't think so. Conclusion should be same, whether you're talking about total or incremental approach. Now, for the required return on incremental, so we are looking at how much investment in receivable, right? So my cost of credit sales, this is what we calculated in the previous slide already. 450, 470, 480, 5 lakhs, 510. So again, we need to calculate the total approach. My vote would be for total approach. I don't know about you guys, because anyways you are doing these calculations. But if the question is asking you the incremental approach, then you should know how to solve it. Right? So if we say the collection period, like 30 upon 360 into 450, 40 upon 360 into 470, you will get the account receivables, sundry debtor balances, or the way you like it, sundry debtors. 37,500, 52,000, 66,944. These are debtor balances. And what we are looking at is incremental investment in these receivables. Now, incremental is coming in from point number C. A lot of work here, incremental approach. And then we multiply that by 20% to straight away. Now, someone can argue that, sir, can't we do it in all together in one formula? You can do that. You can do that. I don't have a problem. But the only thing is that then you are calculating the incremental directly from the opportunity cost, like we did earlier. Students generally ask me, sir, can't we do incremental like 75 and 10,444 minus 7,500, 13,389 minus 7,500? Yes, you can do. You can absolutely do. So now in this case, if you see the net benefit, guys, same conclusion you can see. 3606 is the net benefit, which is maximum for the policy A, and the policy B is slightly behind the policy A. But I am very much interested in looking at what happened to policy D, minus 5350. Remember, we discussed in the total approach that the policy D is taking even the present condition downwards. Right? Even the total approach suggested that from 136, it went down to 131. So negative 5,000 was anyway evident on the cards. I'm sure some of you might have found the incremental approach confusing because of the second part, because they have calculated the receivables, and on those receivables, they have multiplied the 20%. You could have done the straight away, the same way also in the total approach, like you calculate the opportunity cost and incremental opportunity cost. I'm fine. That is also acceptable, guys. And if you want to, rather than having 3-4 rows, you want to just calculate opportunity cost and incremental opportunity cost, that's okay. That is absolutely fine. Because in the total approach, I think you guys are more or less comfortable with that opportunity cost. Here we are first calculating the receivables balance by multiplying the period and then multiplying by 20%. So we are doing the multiplication at 2 levels. In the first method, we are just multiplying all at one go. So guys, I hope this is clear to you. Now, there is one more method which is given in your book called as a expected return approach, which uses the inputs of this incremental expected return approach, which is the formula is incremental profit upon incremental receivables. For this, you would be needing the receivables anyhow. And there also you calculate like whichever is the benefit return is the policy accepted. You can see like 44.49% for policy A. You need incremental profit, which is given to us like calculated by 6550, incremental receivables 14,700. So that gives us a the return on the receivables. Great, guys. So I think we can rest for the day now as we close in. And what's coming towards us in the next episode, the last episode, we will be talking about, let me just show you some slides. We'll be talking about the financing of receivables, factoring, very, very important. And once we are done with the factoring, we'll be talking about some latest developments. And then we will be also talking about management of payables, inventory management, small things. But after that, we will be focusing on some practice practice and practice. That's our agenda of the success anyhow. So we stop here and we continue our lecture on Thursday with the financing of the receivables, wherein you don't want to carry the responsibility of the collections. You want to sell it to someone. This is where we start off, and we have some practice questions to follow. So I'm sure Thursday would be another yet engaging session. So thanks a lot. It was, as always, your kind of responding and my lectures in terms of your two-way approach is always enjoyable by me, and I'm sure you guys are all also benefiting out of these sessions by practicing at your end. It has to be also implemented once we are done with the session. You guys should need to study and do some practice, and keep on the hard work, guys. Be safe, and see you on Thursday. Then have a good night and good time ahead. Take care, guys. Cheers.